Good morning. I'm Doug Pesifal. I'm a shareholder here at the Milwaukee office of Reinhardt Berner Van Duren, where I practice with the tax group. I practice primarily in the area of state and local taxation, although I do a little bit of work with tax-exempt organizations as well. So today what we're going to do is we're going to cover some recent developments in state and local tax. We're going to hit some of the highlights. Property tax, sales and use tax, income tax, even unclaimed property, and a few other areas. We've got a really small group in the room. Thanks for joining us here in the room and on the web. If anyone has any questions as we go or wants to share war stories or talk or whatever else, please feel free to do that. Nancy, how do I advance this?
Oh, yeah, that's all right.
Okay.
There we go. Oh, no. Sorry about that. Let me get that for you.
Are we unmuted?
Oh, yes, we're unmuted.
All right.
There you go. And it's this button to the right.
All right. Thanks for the... All right. So, property tax. We'll start right off. You know, so the other day I was checking out some materials on the Wisconsin Department of Revenue's website. They play somewhat of a supervisory role throughout the state in terms of property taxation. And one of the things that I had come across, I wanted to confirm the number I'd always been using in terms of how many different taxation districts we have in the state. It was real close, 1,850. So that means there are 1,850 different local assessors in the state of Wisconsin whose primary duty it is to find and value real and personal property located within their boundaries. Statewide, last year, local governments and taxation districts levied about $10.6 billion in property taxes. And this was also quite fascinating. The highest tax rate in the state, 47.19 in the village of Brokaw in Marathon County. And in case you're wondering, it has a population of 243 people. So that basically means that in 2015, on a $100,000 property, the tax bill was $4,700. The lowest tax rate in 2015 was found in the town of Manitowish Rivers in Vilas County, with a population of 583 and the tax rate 8.04. In case you're interested, the average throughout the state was 21.54 mils. Just by comparison, here in the city of Milwaukee, I believe last year's tax rate was 29.8 mils, something like that. So you kind of see that it's all over with an average in the low 20s. And Wisconsin routinely gets singled out as one of the highest tax states, primarily because of how much local governments rely on property taxes to fund police, fire, schools, and the like. So just by way of background, and we're kind of talking about top 10 things, but we're talking about recent developments too, and just so that we're all on the same page, we're covering some basics. But property in Wisconsin is assessed at its full value as of January 1st of each year. All property is presumed taxable, that being real and personal property, but not intangible property, not business income. The assessment that the assessor for the local taxation district comes up with is presumed to be correct. It is on the burden lies with the taxpayer to challenge it. So what should the assessment be? It should be full value, also defined as fair market value, which is defined first. This is called the Markarian hierarchy. The first step in the process is to determine if there's been an arm's length sale of the subject property. The second step would be to see if there is no recent sale of subject property. Then you start looking at sales of reasonably comparable properties. If you still have none of those, then you start looking at all other factors to value the subject property, including its income, using the income approach. You start looking at its net operating income. You apply a discount or capitalization rate to that to determine the fair market value. or you can look at cost, replacement cost or reproduction cost. But all property in Wisconsin is assessed in one or more of these manners and at its full value, except for undeveloped land, and there are rules that define that: agricultural forest land and agricultural land. Ag land, important point here, if you're buying property with the idea of developing it in the future and it is currently undeveloped, you want to keep it in that state. For example, if you can have it farmed, as long as it is farmed, it is never going to be assessed at its fair market value. Instead, it will be assessed at its value in use, which is a much, much, much lower rate. So a lot of developers will start buying up land and then entering farm leases with area farmers to keep the land tilled and used in agricultural. So in terms of setting the assessment, what assessors do is they look, this is important if you're buying property in connection, for example, with the purchase of a business or the sale of a business, selling property. When a deed is recorded, a fee is paid on the real estate transfer return. A lot of folks will report the transaction price on the real estate transfer return when it should actually be only the portion of the sale price that relates to the real property. Even when people get that right, sometimes they'll include the value of personal property on the real estate transfer return, which again the assessor is going to look at for purposes of determining where to start the following year in setting the assessment for the property. The assessor has a property file on each property within their district. They will sometimes request property tours, conduct appraisals, request income and expense information, especially after the first of the year. And I don't think I'm speaking out of school to say most property owners, or at least ones that we talk with, will not return the request for income and expense information, because there's really no advantage to doing so initially. Let the assessor commit themselves to a number before, see if that number is in your favor before providing the income and expense information. Cost estimates. So if there's new construction, assessors will typically request information relating to how much cost has been incurred to construct the property as of, say, December 31 of each year, so they can set the assessment for the following year. A couple of quick things before we I'll skip those two slides and come back to them. So the local assessment process, and this applies to all commercial and residential properties within the state, typically starts with, in the case of real property, with information that the assessor has about it. In the case of personal property, Wisconsin is one of the few states that still imposes a personal property tax. Property owners that have commercial property owners with personal property file a statement of personal property each year. There is a notice of assessment that goes out, but only if the assessment changes from the prior year. And even if the assessment does not change from the prior year, the property owner has the same rights to contest the assessment that they do any other year. They just don't get notice of it. There is an open book period where you can go in and meet with the assessor informally, and a lot of times you can achieve success at that stage. If you're do not get the relief that you want at the open book, during the open book, then you can file a notice of intent to file an objection, which has to be filed 48 hours before the Board of Review hearing. In addition to the notice of intent to file an objection, a formal written objection needs to be filed within 2 hours of the start of the Board of Review hearing. And the Board of Review hearing is the step in the process from which all other steps follow. So if the property owner does not attend and object properly to the Board of Review, there can be no judicial appeals that follow that. So the Board of Review is important. The Board of Review also creates some cynicism among practitioners like me in this area, because for the most part, the Boards of Review are comprised of people who live in the community, who have a strong relationship with those, with the assessor and the assessor's staff, with city attorneys, city attorney staff, with the city clerk staff. So it's often stacked from the get-go against property owners. There's always been a tug-of-war and a tension between the city, Wisconsin Assessing Officers Association and property taxpayer practitioners over the rights. The cities will from time to time propose changes to the legislation to restrict judicial appeals, and then there have been a number of cases that have found those to be unconstitutional. So I mentioned the Board of Review. A couple of changes in the law that went into effect last year. Board of Review appearances, it used to be that you had to be there in person. Now the law does provide that the Board of Review may allow the property owner or their representative to appear by phone or to submit written statements. And in addition, there is now a procedure, if the board grants the request, to waive the Board of Review hearing altogether. And where this comes in handy is when you've got an objection to a property, you take a court appeal to the objection. Another year has gone by, you're still pending in court, and now you've got a new assessment year pending. Each year stands on its own, so you keep going through the process. But why go through the Board of Review? Nobody's minds have changed, so there is now a procedure. People have long been doing it informally, but there is now a statutory provision to allow the Board of Review hearing to be waived. Now, we've talked about local assessment, and I mentioned that that was commercial and residential, but there is also a manufacturing assessment process in Wisconsin that is separate and independent of that. Manufacturers who request and receive by March 1st a classification by the Wisconsin Department of Revenue as a manufacturer are assessed by the Department of Revenue as opposed to the local assessor for their real and personal property returns. The idea being behind this change a number of years back was the Department of Revenue will be better at assessing manufacturing property uniformly throughout the state, rather than having the town of Villas and the town of Manitowoc Rivers, for example, assessing their own manufacturing property, since you would have different levels of sophistication, presumably, in different communities. So in attempting to reach uniform assessment of manufacturing property, the Department of Revenue took that over. They grant requests for manufacturing property classification. So the manufacturer files a return, a real property tax return and a personal property tax return with the Department of Revenue each and every year, from which the assessment is based. And the advantage to this classification, in addition, is the fact that manufacturing personal property used directly and exclusively in manufacturing is exempt from property tax. So there are some dollars and cents advantages to being classified as a manufacturer. The appeal process runs a little differently. The Department of Revenue every year does issue notices of assessment. They typically come out in June or July. You can object to the assessment by filing a form with the State Board of Assessors, which, like the Board of Review in local communities, pretty much is a rubber stamp for the state. And then if still no relief, you can file a petition for review to the Wisconsin Tax Appeals Commission, and then thereafter file appeals in the courts. So typical basis for assessment challenges: there's a recent sale of the subject property, there's comparable sales, there's the depreciation. There's many different types of depreciation. Three of them are listed here: physical, functional, and economic. The inability to finance a property at the value that the city says it should be at. Long-term leases that are, for example, below market. Typically, assessors will use market data to assess the assessment. Here, if you've got a below-market lease, you can use that to contest your assessment or raise that issue with the assessor if your vacancy rates are up, and so on and so forth. Or you can argue that the assessment captures business value or goodwill. A couple of quick cases. Refund interest. This case lands in involved a taxpayer who ultimately won their assessment challenge and wanted a higher rate of interest because the state changed interest rates, and the court here said, yeah, you didn't acquire a legally vested right in that earlier interest rate because you did not recover. Your judgment was not equal to or greater than the settlement offer. This case, just a couple of months ago, the circuit court did not commit an error when it failed to consider a 2015 sale of mall property when it valued a property for the 2010 to 2013 tax years, because the court said, hey, the 15 sale involved different configurations. Thermoelectron here, the Department of Revenue, so this was a manufacturing property, had used the building residual method to separately value land from improvements. The court here held that that was inconsistent with the Wisconsin Property Assessment Manual and generally accepted appraisal practices. Typically, you cannot separately contest the land value from your improvement value. That is, lots of cases on that. This case involved the same thing here. The Department of Revenue tried to do it. But another thing I wanted to point out is with the Wisconsin, it's here, WPAM, the Wisconsin Property Assessment Manual. This is the Bible published by the Wisconsin Department of Revenue and used by assessors throughout the state. In fact, they're statutorily required to follow it, and the department is statutorily required to publish it, and it is published online on the Wisconsin Department of Revenue's website. Here's kind of an interesting case, although I'm not sure that it changed as much, but here the taxpayer, the property owner, sued. The town had sent them a letter saying, hey, we want to tour your house for the purpose of determining the proper value of the house for assessment purposes. And the taxpayer sued saying, hey, that's a violation of my Fourth Amendment rights against search and seizure to have you guys come in. The town won this on the basis that, hey, nobody was required to, you didn't have to let us in. Although, you know, the question is, if they wanted to ever contest it, they would have had to. But highest and best use, this is a case, again, this property is supposed to be assessed at its highest and best use. This property involved a shuttered pulp and paper mill, and the Department of Revenue had assessed it using comparable properties that were currently operational. And the case involved, well, could you do that? And here the court held that even though this particular one was shuttered, its highest and best use continues to be as an operational pulp and paper mill because there continues to be a market for that in the area. It's up in the Fox Valley. Here, again, there are a lot of activity in malls, shopping malls, and here the Sears Holding Corporation's case held that the arm's length sales used by the city to set the assessment were reasonably comparable, even though they failed to include the sales of mall anchor stores. Another presumption of correctness case. So the way you basically contest assessments is you have to go in and you have to, because they're entitled to a presumption of correctness, to rebut that presumption, you have to introduce significant contrary evidence or show that the assessment failed to follow the rules, that being the Wisconsin Property Assessment Manual. Once you show that significant contrary evidence or irregularity in the assessment, then you still bear the burden of persuasion. Here in this case, the court held that, you know, the taxpayer failed to even get an independent appraisal of property and therefore failed to rebut the presumption of correctness. I'm going to keep going and we'll change topics here. Nexus. So we talked about property tax, and then the other two big taxes throughout the country at the state and local level are sales tax and income tax. And both of those relate to Nexus. And I'm going to spend just a minute talking about Nexus, and then we'll talk about some of the things that can create Nexus. For sale, so this applies to businesses that are looking to expand their operations. And it's amazing to me. We all want businesses to thrive in our country. I mean, it increases employment, increases the tax base, it increases the value of our economy and all the like. But by God, if you start selling into other states, you're going to trigger a host of requirements that most new upstart successful businesses simply aren't prepared for. See this time and time again. For sales tax, the standard was set in 1992 with Quill versus North Dakota. This, just very briefly, it was a Quill Corporation, was an office supply retailer. They sent floppy disk into the state, if those of you that can remember floppy disk, and allowed people to license those disks so people could check inventory and order online. North Dakota said, well, they had no employees in the state. They had nothing, no property in the state. And North Dakota said, well, Quill Corporation, because you have those little floppy disks and because you license the use of your software in our state, anytime you sell to a resident in our state, you have to collect tax on that sale and remit tax on that sale. Quill sued, and basically the U.S. Supreme Court held that for purposes of requiring a seller to collect or remit sales or use tax, they must have more than a de minimis physical presence in the state. So that seems clear. But income tax, which most states have, and some states have gotten around this, but this case, the seminal case, is actually a South Carolina Supreme Court case that the U.S. Supreme Court denied cert to. Here, the case is not, or the standard is not physical presence, it's economic presence. And the case involved Toys R Us. They were based in Delaware. Their principal office was in Delaware. Toys R Us licensed the use of its name in South Carolina to Jeffrey, and therefore the South Carolina court said, because you are licensing the use of intangible property in our state, you have economic nexus such that we can require Toys R Us in Delaware to allocate and apportion its income that's attributable to South Carolina and pay South Carolina income tax. So, bottom line, it is possible to have sales tax nexus or income tax nexus in different states. In other words, you may have economic nexus in a state and therefore owe income tax, or you may have physical presence in a state and have sales tax nexus but not income tax nexus. And I'm going to tell you why that could be the case in a second. Before we leave this, another thing about this case, the Jeffrey case, is it relates to taxes on net income. So what a number of states have done to kind of avoid this case applying, Texas, for example, imposes a margin tax. It is a gross receipts-based tax instead of a net income tax. So the state of Washington imposes a business and occupation tax instead of a net income tax. So states have gotten away. There's been the commercial activity tax, the business income tax, or single business tax in Michigan and in Ohio. These are all attempts by states to get away from the standard and be able to assess taxes more readily. So even if you have economic nexus in a state, there was a law adopted in 1959, a U.S. Public Law 86-272, which allows a taxpayer to engage in certain protected activities without creating nexus for income tax. As long as those activities are limited to the solicitation of orders or sales that are approved outside of the state. So you can have a sales force in a state that's going around selling, soliciting orders for approval back in Wisconsin, for example, and avoid any liability for income tax, but you're going to create all kinds of liability for sales tax because you've got physical presence in the state. So that's an example of where you could have nexus for one purpose and not for the other. So states, to get around all of this, as I mentioned with the business occupation tax and the margin tax and all the like, other states are moving to a factor presence nexus where if you have sales in excess of a certain amount or payroll or property in excess of a certain amount within their state, you're going to be deemed to have the requisite nexus. This directly leads to a recent case, Direct Marketing Association from last year, typo on the slide, but the state of Colorado passed a law, said, hey, if you're an out-of-state seller and you make sales totaling more than 100,000, not 10,000, in a year to our residents, you must do three things. You must notify the buyer in our state that they owe use tax on their purchase of your product. 2, you must notify them again at the conclusion of the year. And 3, you have to notify us of who you sold to in the state. Quite a stretch. I mean, nobody had done this before. It goes up to the so the Direct Marketing Association sued the district court, issued a permanent injunction against Colorado's enforcement of this. The U.S. Court of Appeals for the 10th Circuit overruled the district court, saying that the injunction was prohibited by the Tax Injunction Act, which is a U.S. law that basically says that the courts cannot be used to restrain the collection, the assessment, the levy assessment or collection of a tax. And so the Supreme Court said this really was not a levy assessment or collection of a tax. Those are all things that happen after the notification. But interestingly, even though it was a 9-0 decision, and I'm not sure any of us could imagine many more 9-0 decisions coming out of the court, but even though this was a 9-0 decision, interestingly, Justice Kennedy issued a concurring opinion in which he said that the physical presence standard in Quill should be revisited by the court. One thing I didn't mention is Quill actually was the Supreme Court's decision originally in Quill did say that Congress had the full authority and power to write its own rules with respect to whether physical presence was required or anything else. Congress obviously hasn't done that, and now Justice Kennedy is saying, well, maybe we should take another look at whether physical presence should be required. So I'm going to skip through these next slides. It looks like we're doing okay on time. But things that can create nexus, there are a lot of slides here, but we'll go through them quickly. Obviously, real property in a state, personal property, employees and agents, and this is the biggest thing that we see with clients. Even law firms, for example, employees and agents will enter a state, they'll visit the state, they'll deliver and install property. You can do a trial in another state, and by your physical presence as an employee of a law firm in another state, for example, in a trial, can create the requisite nexus. Warranty work. Had a client here based in Wisconsin who is what they do is they arrange for independent companies to go service and do warranty work on medical equipment on behalf of manufacturers. So there's the manufacturer that sold the equipment. Customer now has a warranty issue with that equipment. They call the manufacturer's agent located in Wisconsin and says, hey, my CAT scan machine isn't working. Wisconsin company has a list of providers that can fix that CAT scan machine in the state and calls one of them and has them go over there and fix it. Texas takes the position, for example, that that is Nexus creating for the Wisconsin company. The fact that they have agents in Texas that are available to them to send to this customer creates Nexus for the purposes of their margin, franchise tax or margin tax. Sales related, again, a lot of these activities can create Nexus. Some non-sales related activities, conducting training courses, setting up product displays, hiring and recruiting employees, attending seminars and meetings. Telecommuters, another big thing. A college friend of mine who's worked in D.C. for many, many years now has decided he wants to go work in Hilton Head and continue to work for the employer in D.C. That employer now, for all intents and purposes, has Nexus in South Carolina. Even though they don't have an office, they now have an employee who works in South Carolina. Third-party relationships can create, including on the internet, can create Nexus. Distribution and delivery, especially using your own trucks as opposed to common or contract carriers. Attending trade shows, appearances in court. I used to work with a firm that did a trial and wrote legal briefs for a client located in South Dakota. South Dakota Taxes Legal Services. So the presence in South Dakota, and South Dakota took the position that even if you were writing the brief in Wisconsin, if you were writing it for that South Dakota-based client, you had Nexus with South Carolina and were required to collect and remit sales tax. Financial activities, affiliates, again, affiliates. This is where all of the activity is in Nexus for sales and income tax. Internet activities, we've got a number of clients who are providing software as a service. So basically what this is you log into their website and you use their server to do data processing or to order things or whatever. There's nothing that resides in your computer. You're accessing somebody else's computer over the internet. Most states take the position that that's not a taxable service, but there are some that do. So it is a state-by-state analysis. Digital property, we're going to talk about this in a little bit. Even some things as simple as holding a certificate of authority in a state, maintaining a bank account or a P.O. box can trigger the requisite nexus. So how do you determine if this is an issue for you? You know your operations. Talk to your people. You go in, not just accounting and finance. A lot of us will limit those discussions with those folks. But you've got to talk throughout the company. Talk to the training group, to the warranty people, credit and collection, engineering. What are we doing? Where do we do it? We always start when we have clients that have expanded and have grown and are still filing only in Wisconsin, for example. We'll say, let's make this manageable project. What are your sales by state? List them. And start with the highest state and go down. What are your history of sales? What are your projected sales? Which states are aggressive? Typically California, New York, Texas. It's a small number of states that get really aggressive in this area and that should be dealt with first. How do states, do you have disregarded entities that are doing business in a state? Single member limited liability companies. Do you have bundled transactions? Where are you selling? Where are you advertising? How are you advertising? And the reason this is such a big deal is because, for example, the customer or the client that I mentioned that was sending techs to do warranty work in Texas, the way they got picked up is one of those techs got audited by the Texas Department of Revenue. They came out and they said, hey, we want to see all your invoices for this year, and shared them with them. And the auditor that's what states do. It's like their intelligence. They go out, they see where you're buying from or who you're selling to, and then they look to see if tax is on those invoices. And then they start contacting. I'm sure they do some mental analysis or whatever in terms of where the biggest bang for the buck is going to be, but they're going to reach out to the companies that they think they can get something from. Purchase documentation, we see this time and time again. Credit card purchases, the Department of Revenue will want you to show that you paid all applicable tax on a purchase, and time again, companies will simply reimburse employees on the basis of credit card receipts, and those credit card statements, and those credit card statements say nothing about whether tax was paid. We all know it was paid. It was an over-the-counter, most likely paid, over-the-counter purchase. You give them the credit card, you toss the receipt, the your company gets the credit card statement, and there's no proof of tax having been paid or even what the purchase was. It can be a costly item for companies going through a sales and use tax audit. Sale documentation, resale and exemption certificates, over and over again. If you're not charging sales or use tax, and you should be, given the nature of the sale, either do it or collect an exemption certificate or a certificate claiming purchase for resale and maintain those. Other taxes, again, we talked about property, income, and franchise. There are surcharges in many states. There are certificates of authority that impose taxes. If you acquire a new business, you're acquiring exposure in states that new business does. So you find that things have not gone well. You have some exposure in states. Most states now, nearly all of them, will offer a voluntary disclosure process where you can voluntarily approach the state and commit to coming into compliance by filing and paying back taxes. Sometimes it's a formal program, sometimes it's an informal program, and basically what I mean by that is it's either statutory or non-statutory. In Wisconsin, we do have a voluntary disclosure program. It is informal. It is a great deal. So the way this works is you can have that initial contact with the Department of Revenue in whatever state be anonymous. So your accountant or your attorney can contact them on your behalf, describe the facts that give rise to the possible exposure, and then make a pitch for, typically in Wisconsin, if you don't file an income tax return or a sales tax return, the statute of limitations never runs. Here, with the voluntary disclosure program, one of the big benefits is they'll limit the look-back period to 4 years. They'll say, no harm, no foul, you're coming clean. We'll limit the look-back period to 4 years. We'll waive all civil and criminal penalties related to your non-filing. In Wisconsin, if you haven't filed and you're found to owe tax, it's 18% tax or interest rate. That can be reduced to 12% under this program. Texas doesn't charge any sales tax or any interest on voluntary disclosure. So if you come clean, whether it's for 4 years or I think it's a 4-year limitation or look-back period in Texas as well, no interest, as long as you do it through the program. The biggest disqualifier for the program is being contacted by the Department of Revenue first. So a couple more things on sales tax. I don't know in everyone's case here, transportation subsidiaries in Wisconsin. These just some random thoughts. Here in Wisconsin, unlike a lot of states, this is kind of unique to Wisconsin. We provide an exemption to sales and use tax for trucks that are sold to a contract or common carrier. Now that seems simple and non-sexy enough and everything else, but I want to point out something. A contract carrier is one that hauls goods for others for hire, and that when the title stays with the title to the property being transported doesn't pass to the contract carrier. So what this means is, say you have a furniture store and somebody goes there and buys a couch or a chair and they want it delivered to their home. If the furniture store uses its own trucks to make that delivery, it's going to pay sales tax and use tax on the purchase of those trucks, because it is not a contract carrier. It's not hauling someone else's product. But if that same furniture retailer sets up a subsidiary that makes all of its deliveries, licenses the use of its name to the subsidiary or whatever else, that subsidiary can now purchase the trucks free of sales and use tax. Perfectly legitimate planning technique. It is one that the Wisconsin Department of Revenue has outlined in their publications. So there's nothing untoward here. We've done this in a number of cases for clients of ours, ice cream manufacturers that make deliveries, for example, others, where you can engage in this type of planning to save significant dollars. I mean, the trucks are expensive. Not only does it apply to the trucks, but it applies to accessories, attachments, parts, supplies, GPS units that are used in connection with the truck. It is a wide-ranging exemption. And the part of the process, so we're not talking about creating a whole new employer. Typically what's happened is, going back to my furniture retailer example, furniture retailer would assign or lease some of its employees to the subsidiary that does trucking, presumably the same people that used to do it before. We can't really say lease anymore because the laws have changed for unemployment tax purposes, but there are ways to plan around that so that everybody can do that. You get a license carrier number from the State Department of Transportation or the U.S. Department of Transportation, and we've been down this route quite a few times. Wanted to mention here, this is a change in the law recently, occasional sales exemption. Generally speaking, nonprofits, as defined here on the slide, that make sales or they purchase in Wisconsin free of sales and use tax. So they don't have to pay tax when they buy tangible personal property. What many of them do not realize is when they make sales, they are, like any other business, required to collect sales tax or remit sales tax on those sales unless they qualify for the occasional sales exemption. Most of them qualify for the occasional sales exemption. Most of the smaller ones do. The occasional sales exemption, in order for them to qualify for it, and this is of value to those of us that are involved with nonprofits on the board of directors and so on and so forth. But the nonprofit qualifies for the occasional sales exemption relating to sales it makes when it does not hold and is not required to hold a seller's permit. That's pretty easy. And does not make taxable sales in more than 75 days in a year or of more than $50,000. Those numbers are going to affect January 1st of 2017. Previously, they were 20 and 25,000. In addition, so you have to meet all three of these tests in order to not have to collect sales tax. The third one is no entertainment is provided at which more than $10,000 is paid for the entertainment, or no entertainment for which more than $10,000 was paid at an event that was charged, for which admission was charged. And this is up from $500. Doesn't matter who pays for the entertainment. If the United Way wants to have a celebratory dinner and they pay, or a private company pays $10,000, more than $10,000 for that entertainer, even though United Way didn't, it would trigger the requirement. It doesn't matter who pays the $10,000. If they charge admission, that takes them out of the occasional sales exemption. Jukeboxes. Something I've learned is
Really getting the high stuff now.
Really getting the high stuff now, yeah. And I'm like, watching my signs back there too. This is where this can get really fun. Jukeboxes, they've evolved. You can now go into a bowling alley, a bar, wherever you're going, and there are basically two kinds of people. There are the kinds of people that go out and put the dollar in the jukebox, and then there are the people that download the app, put their credit card in it, search for music, and play the music from the app. The two big purveyors of these now, TouchTunes, AMI, usually one of those. They're basically electronic jukeboxes. None of them have records in them anymore or whatever. So what this involved is that, so the Department of Revenue, nobody has argued the point that the dollar into the jukebox, whether you're putting it physically into the jukebox or you're doing it on the app, nobody disagrees that that dollar is subject to tax for sales tax. It's a taxable admission. It is a charge for the use of an entertainment, recreation, athletic, or amusement device. That dollar is taxable. But now with the new jukeboxes, the operator or the owner of that jukebox is having to pay 20% to AMI or TouchTunes for the right to use the song that is played on the jukebox. And the Department of Revenue has taken the position that that 20% is the purchase, a separate purchase of a digital good. And the jukebox industry was saying, well, no, we're buying it for resale through the jukebox. And they're like, no, those are two different transactions. You have a taxable admission on the front end, and you have a purchase of a digital good on the back end. Those are two separate transactions. For every dollar into that jukebox, you owe us a tax on $1.20. So what we did, this is for a client of ours, we drafted an exemption that provides an exemption for the sale, use, storage, or other consumption of music that is sold in a tangible form, and that's some magic language because the Department of Revenue did not want the definition of digital good to be altered in any way, but there is a statute that says if you can sell it in a digital form or in a tangible form and it's exempt, then the digital form is also exempt. So if the music is sold to a person in the business of providing a service through a taxable service through a jukebox and it's only used on that jukebox, then it is exempt. And that was effective here in June. And so getting back to the admissions, and again, whether you, private company or nonprofit or wherever, admissions is where the action is for the Department of Revenue these days. And just to review the statute, admissions to amusement, athletic, entertainment, or recreational events or the privilege of access to such devices or facilities, even membership rights and club memberships, are subject to sales tax in Wisconsin, or use tax. So what this means, entry fees for runs, walks, races, golf outings, dances, parking, silent auctions, club memberships, fundraising, dinners. If you are, in the case of a nonprofit, if you fail to qualify for the occasional sales exemption on your sales, or if you're not a nonprofit, you're in trade or business of doing these things, if you're making these kinds of sales, the Department of Revenue has taken the position that they are taxable admissions. Statute of limitations on sales and use tax refunds, slight change here, worth noting. The statute of limitations now begins to run from the due date of the income or franchise tax return that corresponds to the year in which the transaction occurred, as opposed to the year in which the tax was paid. So that statute runs 2 years. And then if you are filing a claim for refund following an audit, that claim for refund may only include items that were adjusted in the audit determination. And this is effective earlier this year. Building materials exemption, that's another area in sales and use tax that has changed recently. So real property construction activities are those where a contractor goes out and they construct or improve real property. The law in Wisconsin is when that contractor goes out to buy the materials used for that purpose, they owe use tax on their purchase of those materials, because we do not assess sales tax or use tax on real property. When the contractor buys it, they have to pay tax then. They're deemed under the law to be the consumer of the materials they use in connection with a real property construction activity. That's the law. What happens is when the customer, for example, a nonprofit, a hospital, a school, a county or city government, when they're purchasing, or when they enter a contract with a contractor to construct a new wing or new school, new hospital, new whatever, they would ordinarily be entitled to an exemption on their purchases of those materials. But for the fact that Wisconsin defines that as a real property construction activity and requires the contractor to pay the tax when they buy the materials, the nonprofit could buy them tax-free. So the planning technique forever has, and again blessed by the Department of Revenue, had been for contractors to set up a separate subsidiary, a supply company, that would act as the agent of the nonprofit, buy the materials for resale to the nonprofit, that would give them to the contractor to construct the improvement. And so everybody had to go through this charade for many, many years. The law was recently changed to allow that if the real property construction activity is going to be for an eligible entity, a nonprofit, then the sales may now be made tax-free. So nonprofit entity gives contractor an exemption certificate or purchase for or exemption certificate. The contractor can now give that to the seller of the supplies and the materials. That applies to facilities that are going to be owned by a county, municipality, school district, or nonprofit organization. State organizations are not in there, so UW, commissions and districts like Metropolitan Sewer District of Milwaukee, multi-county railroad commissions, for example, and the like. They will, even though they may be exempt, they're not covered by this. And it also defines facility. It was effective this year. So while it reduces the need for the supply company, it doesn't eliminate the need for the supply company, because there could be facilities or entities that might otherwise qualify that are not covered by the statute. New exemption for out-of-state disaster relief responders. If the governor declares an emergency, state of emergency, out-of-state businesses can flood the state and not have to comply with income tax withholding rules or pay use tax on the materials they bring with them. And they don't create nexus for sales and use tax purposes. But they do have to give notice to the Department of Revenue. Another case that I mentioned, Orbitz. We've all used Orbitz, Travelocity, Expedia, or Priceline. This is kind of an interesting case. It's been percolating its way through the courts for some time, but here the Department of Revenue did an audit of Orbitz. Orbitz would charge the customer a fee, a charge for renting a hotel room, reserving a hotel room. The department, and basically Orbitz would keep a portion of that charge as its fee and then pay the rest to the hotel. And it would collect tax on the portion and remit tax on the portion that it paid to the hotel. Actually, the hotel did it based on its receipt. But the Department of Revenue did an audit. It said, no, that percent or two that you're charging, your fee, is subject to tax because Wisconsin charges tax on the furnishing of accommodations. And here the Court of Appeals in Wisconsin held that the Orbitz was not liable for tax on the amount of the payments that it retained as compensation because it was merely an intermediary and was not the party who furnished the lodging and therefore did not provide a taxable service. Again, the department had argued that, the online service allowing people to arrange for lodging was the furnishing of rooms. And the commission, Wisconsin Tax Appeals Commission and the courts thus far have concluded that it was not, that Orbitz was not a furnisher of hotel rooms. And this brings up an important tax law concept. They said there was ambiguity in the law. Any ambiguity in a tax imposition statute should be resolved in favor of the taxpayer. If it's an ambiguity in an exemption, it's typically strictly construed against the taxpayer. Last thing I wanted to mention is Wisconsin has, or a couple quick things, Wisconsin has adopted the federal code provisions, Internal Revenue Code provisions relating to economic substance. Those were effective this year. So a transaction is treated as having economic substance by reference to the Internal Revenue Code, and that tax effect is determined by looking at both federal, state, local, and foreign taxes, not just federal. Unclaimed property. Know that the Wisconsin Department of Revenue now handles unclaimed property, unused gift cards, unused credits, uncashed checks, wages, you name it, must be turned over to the state after the requisite abandonment period, usually around 5 years. Wisconsin and Delaware are now in a big fight because this is big money. Moneygram is a money transfer company. They issue checks. And the question here is whether those checks constitute money orders or whether they're official third-party bank checks. If they're money orders, then the unclaimed payments go to the state after they've been abandoned in which they were purchased, which is favorable to Wisconsin. If they're considered to be checks, then those unclaimed payments go to the state of incorporation, in this case Delaware. So Wisconsin Department of Revenue filed a claim in U.S. District Court alleging that Delaware owes Wisconsin $13 million for uncashed money orders. Delaware says, no, those are checks, and you owe, we're going to keep it. It is now in the Supreme Court. 19 other states have joined the suit, all ganging up on Delaware. And my final point here that I want to just kind of touch on is mobile workforces. We've talked about income tax, we've talked about sales tax, property tax, unclaimed property. If you send employees to other states, technically you must collect or withhold on their wages for the state in which they perform the services. Different states have different thresholds. If you have, even when you have an employee there temporarily for a week or so, you still technically must comply with that state's withholding requirements because wages are generally subject to tax in the employee's resident location and in the non-resident work location. Both states have a claim. And here the states have an incentive to enforce these rules when you've got a high number of non-residents or telecommuters and you've got a high income tax rate. So think California, Minnesota, New York, Oregon, all states that have been somewhat aggressive in this area. And again, lack of compliance can lead to withholding tax liability, personal liability, loss of business license, publicity. Some things that can give or tip off a state can be vehicles that are driving around the state with the company's logo. Officers are highly paid employees who are performing highly publicized services in a state. Through media reports, the Department of Revenue can say, hey, see that you're doing business here, and we want income tax withholding on that employee. So with that, I have concluded my remarks, and I appreciate everybody's time. Any quick questions? All right, thank you.